Okay, there we go. Let me check if everything is working. And then we can start today's live stream. FOMC meeting coming up. Super excited to see what's about to be next here and what's going to be happening. I will wait for the first people to join to come in. Sorry, I just tried to start the live stream, but unfortunately I don't know what happened, to be fair. It should be working now. I will check on my phone also, and we'll just head over to my X. Let me check. Let me check. Perfect. First people are starting to join. I see. I will open the live chat in another tab so I can discuss some questions. Good afternoon, my favorite Crypto TA YouTuber. Thank you so much. Hello. Nice to have you back. Shout out from Brazil. Thank you so much. There we go. Okay, let's dive in directly here because we have the FOMC decision coming up in about 30 minutes here. A little bit longer, 27 minutes actually. So I will just discuss some stuff before we are going to be heading in. And then we have the FOMC decision. And then 30 minutes later, we have the FOMC, or not the FOMC, but the Powell speech. And that's of course going to be a very important one. And I'm very excited to see what Powell is going to say. Because let me dive into the content directly, because then I can show you guys why I'm so excited for this FOMC meeting. I'm sorry if the audio or something is not on point. I'm in a different setup. I will be moving into a new home soon, and then it will be much better. But for now, this is all I have, and I hope the audio and everything is good. What do you think will be happening? I will be diving into that now. Let me show you guys what I think will be happening. Because of course into this morning's update video we discussed a few things. For example, we discussed that a lot of big asset managers or a lot of influential people are now thinking that the Federal Reserve is going to end QT this cycle of this meeting basically, end QT. And we are also seeing some stuff coming out of the beginning of QE. I think for this meeting the most important thing is going to be the ending of QT. If that's going to be the case, it's of course going to be massively bullish for crypto. I hope so. Let's see. That's going to be the most important thing. Because looking at the market and the rate cut decisions, I will refresh this. Because in 24 minutes we have, of course, the next FOMC meeting incoming. And we have a 97% or 98% chance of another rate cut. So the market is very certain of that to be happening. So what we're looking for are, of course, some other catalysts that could be driving the Bitcoin price back up and the Ethereum price back up and some altcoin prices back up. So what I'm personally looking for is the ending of QT. And that's something we discussed in this morning's update video with a few different posts, for example, here. But also we have JP Morgan and the Deutsche Bank both expecting the Federal Reserve to end quantitative tightening today. That's of course going to be a massive event. If that is really going to be the case, it will be a massive event. Maybe 25 BPS today. I'm reading the comments. Oh, one sec. I'm reading the comments. Audio is good, amazing. If Jerome is going to be replaced, it would be nice for him to end Q2 as his parting gift. Yeah, maybe. But he will most definitely be replaced. It's not going to be the question if, but when. Hello, brother. Nice to have you back, Nero. Nice to have you back watching the stream. But yeah, maybe 25 BPS. I think it's most definitely going to be 25 BPS. Since that's what the market is pricing in, and I'm quite certain that's going to happen. But the most important thing, like discussed, is going to be the ending of QT. Because I have some charts about this also. Let me check it out. Look at this. The Fed balance sheet is going to be, of course, the most important thing we are looking at for today's meeting. If QT is really going to end, we do know that once QT ends, normally QE follows. And if QE is going to follow, it is going to be a very interesting period for altcoins, most definitely. I think for Bitcoin too. I think for the crypto market in general, it's going to be a very interesting period because QE is going to give us some momentum for risk assets like crypto, all of crypto basically. And that's why this could be such an important meeting, because we do know that once QT ends, like we saw for example in 2019, QE follows. And we don't know for certain how the price is going to move. For example, altcoins saw a big move up after QE started and then moved back down during COVID and then eventually headed up higher. So it doesn't always mean that an altcoin rally is going to start immediately. But we do know that once QE starts, usually a very bullish period starts for altcoins afterwards. So we have a very interesting meeting upcoming, I personally think. Thoughts about doing project reviews videos? Of course, I can be doing so, but depends on the project and depends on it depends on a lot of stuff, but I'm always open to do so. Just send me a message if it's interesting to you. But yeah, we have the ending of QT and maybe even the start of QE. That is most definitely what the BOFA head of the US rates is currently expecting. So let's see about exactly that. I'm very excited. And that's why I think it's going to be such an interesting meeting. Because looking at the Bitcoin price, we have some interesting stuff ahead of us. We are of course getting rejected of this major resistance level for Bitcoin in the range. And we do know that from off this level, we've always seen quite some large corrections to the downside before eventually heading back up. So let's see if history is going to repeat there. But what we also do know is that once Bitcoin breaks this level back to the upside, so this level back to the upside, it is always a very bullish scenario, because then we most of the times do make new all-time highs. So we have a very interesting meeting ahead of us. Hello bro, it's Jeremy GZ, hoping we will have a deal round in TG. I will check our messages in just a few moments, brother. Thank you so much for reaching out. When FOMC is going to start in 21 minutes. 21 minutes. Yeah, 20 minutes now before the FOMC. $20 now. So yeah, we have a very important resistance for Bitcoin, guys. So sorry, sometimes I'm also watching at my phone to see the latest news dropping. FOMC gives me FOMO. Yeah, me too. Most definitely. It gives me FOMO, but also a lot of excitement because we have a new market direction. Because looking at the Bitcoin price, we are now dropping back below the bull market support band. So we are at quite an important level just before the FOMC is going to get started here. Just at the bull market support band bottom. So if Bitcoin, or is Bitcoin going to be holding above this level, it's going to be very bullish. If not, we might be in some trouble. So let's see how this is going to continue here. But it is most definitely going to be a very interesting level above the bull market support band. And like stated in a lot of my updated videos, I don't want to keep repeating myself, because I think a lot of people watching the live stream do know that I think that once Bitcoin is going to break below the 50 weekly moving average, we are going to see a bear market. A lot of people do know that by now. So yeah, of course, if Bitcoin is going to drop below to those levels, I think a bear market is going to be likely. But for now, it doesn't seem like Bitcoin is going to be doing so at the current moment. What do you think of RSI on the weekly? I think we could go and retest lower band of the triangle that is forming, and then possibly moon. Question is, how would it translate price to the RSI level of 45? The weekly RSI level is indeed very important. I don't know how it's looking like. I know the weekly RSI, I don't think a retest is necessary. I think with the weekly RSI, it's going to be important to be breaking out to the upside. because if you compare all the Bitcoin highs this cycle, you can see a very nice correlation between them. And I think it's important for Bitcoin to truly make a higher RSI move in the end stage of the cycle, to truly show it's going to be the final wave and the final push. And of course, that corresponds with a higher RSI. And that's what I think is going to be important. And retest, I don't know, maybe. It could be, but I don't think it's going to be important. Is the FOMC going to start in 20 minutes? Yes, it is. It's actually going to start in 18 minutes. In 17 minutes, we will have the FOMC coming in. So stay tuned. We will have our eyes on news. And I will also be live streaming the FOMC itself. Let me see if I can find it on YouTube. Just a second. Bitcoin. There it is. We will be waiting for that. We have a CME gap on 111.2k and we only reached 111.6k on ETF. Yes, I saw, but I think Bitcoin fully closed the CME gap eventually. Let me check it out on the news. I think I saw a message from somebody coming in that Bitcoin reached the Fomc CME gap. Guys, this is also the moment to be asking some questions before the FOMC. If you do want to know something, make sure to ask it now, because now I have some time to answer. Let me check it out. I think the full CME gap is close. I just saw it coming in from a friend of mine. And 116 on the ETF. Let me check it out. Let me check it out on the live stream. Look at this, I would say it's fully closed, right? Isn't it? Is it or partially? I don't think it matters that much. Maybe we'll fill it completely up, but I think after that we will eventually be heading high, to be fair. Why aren't all the ETF money inflows pushing your price back up? Good question. It's because there isn't enough retail to be pushing the price higher. So we do know that during this Bitcoin cycle, I will quickly show you. And this is not what is necessarily happening, but this is what I think happens for Bitcoin during this cycle. Let me show it to you. Because I think what we do see during this cycle is something different than what we've seen before. Look, if you, for example, compare with the 2021 bull market, so to answer your question, we have the 2021 bull market here. I will just quickly draw a line. Like this. Boom. The difference between 2021 and the cycle now is going to be a very important one. And that is that in 2021 and 2020 it was just, boom, almost one big move up. That's the big difference. Here in 2023 to 2025, what we have seen is something different. What we saw here is big consolidation phases, but most definitely here, for example, here, and also here now, big consolidation phases. And why I think that is? Because you're stating We are seeing indeed some big ETF inflows. So institutional money is flowing in during this entire time. So price is consolidating, but retail is selling off. For example, here at the move to 70k, at this level, retail is starting to sell off their Bitcoin. And that means that we have some sell pressure coming up for Bitcoin. And institutions keep buying during this consolidation phase, but retail keeps on selling. And once retail is going to get back, once a little bit of hype gets back into the markets, I think that is normally the moment where Bitcoin does tend to get moving. When those two powers combine, that is where we see those big pushes up, like we saw during Trump's win, like we saw here in March, and like I think we will see again in the ending stage of the cycle. So that's why it's just a game of patience, and why it's a lot different, because something like this, we've never seen this before. Let me get back to the chart. We move off the drawings. We have never seen something like this before for Bitcoin, like 2024. Such a long consolidation phase. We've never seen it before. It's different. It's because institutions keeps on buying, retail was selling off, and then we had higher. Because I think if Bitcoin was truly going to be retail focused and not a lot of institutions involved, maybe this was going to be a major topping level for Bitcoin. And of course we could also see some consolidation and then another leg higher. I don't know, but I think this cycle would have looked so and so different if it was purely based on retail and not on institutions. So that's to answer your question. Let me read the comments quickly. Where nothing is happening and BlackRock another bias mirrors already. Yeah, I just answered your question. Are you guys bullish or bearish now? I think that's a question for the chat maybe, but I don't know, cautiously. Mr. Crypto's only yapping on the stream. Really? Mr. Crypto is like a very good friend of mine, so I hope his stream is doing well. I think we're stuck in the hope stage for too long, but optimism is next. I hope so. I hope so. Maybe it depends. It's so hard to predict a cycle based on the emotional market cycle, the Wall Street cycle basically. It's so hard to predict, but maybe. Institutions like Bitmine are buying through OTC via exchange, yeah, but it should not really matter that much, I must say. Goose Legend, thank you so much. Thank you so much, guys, to be back here. Amazing. Looks like we have a rounding of a major top distribution phase to me. Maybe, indeed. I'm open to the scenario that Bitcoin is indeed trading in sort of a distribution phase, but it doesn't really matter because even in that case, I think Ethereum is going to, for example, have a nice move back up. And guys, to remember, let me check if I can. Am I still going to be locked in is the big question. I am. Here with my trade, I hope I didn't show too much info, but here with my trade, I'm still in quite, now, not that big of a loss to be fair, my Ethereum trading position. I will just give a quick update on that. My Ethereum trading position, I would just keep it open for now also with the Fomc. I do Ethereum is going to be heading higher because or in this final stage Ethereum is just going, or Bitcoin is just going to consolidate, or Bitcoin is going to be heading higher. In both cases, I think Ethereum will see a final leg up, like it has seen in all the Q4s during the post-halving years. It would not make a lot of sense to me for Bitcoin to not see this, or for Ethereum, I must say, but also for Bitcoin. So that's why I keep my trade open. And we have been slowly DCAing in. So if you do want to join me with this Ethereum trade, for example, because I'm not even talking about it that much anymore, because most of the guys on the channel do know it by now, but you can join this trade with the link in the description on this live stream, and there you can claim a deposit bonus and start trading on LBANK. And there you can claim some good bonuses, some deposit a deposit bonus, and you can also trade a lot of different altcoin pairs on LBANK here. So make sure to come and check it out if you're getting interested in that. Of course, in no way financial advice. Let me check the comments. Whoa, what a cycle. Whoa, I understand what you mean, brother. Maybe go up. Looks like a rounding of major top distribution phase to me. If you use data, if you use data range tool on trading view from cycle tops to cycle bottoms to loss automate perfectly on time as a cycle peep. Yeah, most definitely. Bitcoin currently has topped out on a major 4-year cycle pattern, I would say. I'm aware of that. We also made some content about that on Crypto Rover, but also on my own account. We did put out some content on that. We do know about that and we are aware of that, but still I do think Ethereum could make a move higher. Because it would not make a lot of sense for me to Bitcoin to just top out at those exact levels. This cycle will go down in history as one of the crypto cycles. I hope so. I have a 100k long position on Fartcoin with 10x leverage. Okay, interesting. Let's see how that will go. I'm long on Aster. Aster is finished. I don't think Aster must be finished. If BNB is just going to catch some momentum again, Aster won't be finished, I think. So yeah, let me dive back into the comments and into the chat. Let's see if some new stuff is coming out. According to JP Morgan Stanley, this is what the Fed statement red line will look like. Let me dive into this. Okay, interesting. We are pumping. Okay, let me open the charts. I don't think we are pumping by that much, but Bitcoin 5 minutes. We are bouncing back up indeed. Ethereum. Boom. Ethereum is bouncing back up a little bit more, I would say so. Interesting. They're pumping because people always long Fed meetings with high rate cut probabilities and they always get destroyed. Maybe. The announcement about the future rate cuts economy is the important part which could decide if he. I think the most important announcement of the FOMC is going to be QT or QE. If you're going to hear those words, it's going to be a very interesting announcement. But the rate cut itself is priced in, so it would not affect the markets by that much. But QT or QE is of course going to be a massive event. FOMC coming up in 4 minutes, guys. 4 minutes. Let me check my phone if I missed something. FOMC in 2 minutes, 2 minutes, 2 minutes. FOMC decision in 2 minutes. I'm long. There we go. We need QE, of course, if you are after the fact. Sorry guys, I'm also looking at my phone because I'm super excited to see where this is going to be heading next. Let me open X. One new page so we can watch it in real time. JP Morgan have two separate crypto stable coins. Let's see. 1 minute before the FOMC decision, probably 25 BPS rate cut. Let's see. FOMC decision is going to be different than the speech, guys. So the speech will be starting in 30 minutes from now on, but the rate cuts are coming in now, actually. It's happening now. Fed cut interest rates by 25 BPS. Just like expected. How's Bitcoin performing? We are dumping on this news. Crazy. Why are we dumping? And we are pumping back up. Okay. Crazy volatility. Insane. Fed Chair Powell cuts rates by 25 BPS, just as expected. 25 BPS. Breaking the Federal Reserve cuts rate by 25 BPS. Yes. I will also do a quick post on my X. Oh, whoa, I'm seeing something crazy coming in here. Let me check it out. Whoa, I'm seeing something very crazy coming in. Let me check it out, guys. It will halt balance sheet on December the 1st. Whoa, crazy. Okay. Let me quickly post this. So QT is stopping, guys. QT is stopping. Fed to end QT from off December the 1st. So October, November, December. Okay, bro, that is some big news. Let's see how the markets will perform on this. Pumping back higher now. Look at this volatility, guys. Insane. But yeah, Fed to end QT at December the 1st. So that's going to be a big one. We have some big news coming out here. Let me check the comments. Goose, LFG. Where's Powell? He will be. Powell will be speaking in. Let me check it out for you guys. In about 25 minutes from here on. But yeah, 25 BPS rate cut and QT to be ending at the 1st of December. Let me check it on my account. Here, news coming in. QT to end from off the 1st of December. So I was talking about the balance sheet earlier in this live stream. Why are we dumping? Crazy. This is a very bad sign, I must say. This is a very bad sign. Why are we dumping on the news that QT is going to be? I think, well, this is a very bad sign. This is a very bad sign. Bitsy is the only rut. It seems like, yeah, indeed seems like that. Bear market starts on the 1st December. Manipulation at its finest, it would dump it as well, and many readers would ape and think it's easy money. November will go parabolic. I hope so, man. The price action here is absolutely awful. After such an announcement, like QT is going to be ending, it's so bullish for crypto, but still we are dumping. It's showing some big weakness, I must say. I've noticed that whatever the first move is, the market goes in the opposite direction. We are bouncing off the massive 4-hourly fair value gap. I hope so. I don't know about the 4-hourly fair value gap, but yeah, I think the market is looking a little bit weak here. Why would we dump on the news that QT is going to be ending at December the 1st? It's going to be massive news. They can't have everybody long. Maybe. I hope so, man. It's very bad, I think. Wintermute wants to mute your wallet. Maybe. Just keep my eyes on the price section and on the news. Bitcoin supporter and Fed member Stephen Myron supported a 50 BPS rate cut. Interesting. Also up 2% and Bitcoin's down 2%. It will bounce. Oftentimes, price declines until tariffs are removed from China. There will be a lot of uncertainty. I see a diamond pattern in the daily. Fair or not, always same. Buy the rumors, sell the news. Wintermute wants to mute your wallet. Uh, it is quite depressing, man, to be fair, that we are dumping like this at such news. It's a very bad sign. I will keep my eyes on the price section, and I must say, in 20 minutes from now, we have the Powell speech, of course. So I will be live streaming that. But I think it's a very bad sign that after such an announcement, the market is reacting so weak. It is a very bad sign. Don't worry, Mr. Trump will speak something on traffic and everything will be liquidated. Tariffs, I think you mean? Yeah, maybe. Let's see. Okay. Sorry guys, I'm also just looking at my phone. Oh, this price action, man. What the hell? Dumping on QT. It's not goose, it's ok. We have tomorrow Trump meeting with XC. You will be live streaming tomorrow. Yeah, of course I will be live streaming the meeting. Of course, of course. It's expected. Look at every FOMC meeting and the price dump afterwards. Indeed, we have been dumping after last FOMCs. Bad news, or especially why it's not even moving. Like, what the fuck are we, or what are we doing with these markets? Come on, it is insane. Let me see if we have some new stuff coming out. In 50 minutes, we have the Powell speech, so that's of course going to be a big one. Michelle, I think you have to put Besant in Fed, have him lobby. Interesting. Let me put my phone on the charger quickly. Okay, I'm back. Why it's not moving? Kind of bearish. Rate cuts into the end of the cycle and the end of the bull run for the entire stock market. What if alt season never happens? Yeah, what if? What if? Let me check pump now. I would just keep my my eyes on the price, man. Here at the charts. Let's see. I can't tell you guys too much, or I can't talk about it too much. Look, I think the news coming out, QT ending, and possibly the ending of QT is all signaling an beginning of QE. So it's super bullish. It's super bullish for crypto, I think. So I would love to see a bigger bounce from here, back to the upside. But let's see about exactly that. Because this is not what I want to see after such an announcement. I think this is looking very weak. So I want to see a positive Bitcoin reaction in the next 3 hours here. Otherwise, I might be changing my stance on the markets. To be fair, but now it seems like we are bouncing back. QT ending, more cuts, money rotation. Out of gold, we are good. Everything in between is just noise. I'm buying. This is quite a big push back up, I must say. Two descents actually in the Fed. Let me show you guys. One, the Fed official did not favor any cut, and Miran, Fed official Miran, wanted a 50 BPS cut. Market makers are playing mind games, possibly. Possibly a bounce rate is 50%. Ooh, it's quite a large bounce we are seeing now. Let's go. Let's hope this is going to continue. Big push for Bitcoin now. Also for ETH. Interesting. Looks good, looks good. Let's see if it will continue. Look, I think just watching at the news, and I think it's super bullish for crypto, so I'm expecting a bump back up higher, but I did not like the initial reaction of crypto here and the crypto markets coming back down ever so slightly, but let's see. In 10 minutes from now on, we have the FOMC meeting coming up, and I will be live streaming it. Unfortunately, at the FOMC meeting itself, I will be away, but I will be turning it on so you guys can listen to it, and then I will be ending the live stream afterwards. But still some time to that. 10 minutes the speech, and I will live stream the full speech here on YouTube. So make sure to stay so we can be watching it together. Make sure to stay. Sorry guys, I have a little bit of a cold.
Oh, ik moet even fluisteren, maar ik voel me zo ongelooflijk, ongelooflijk lekker. Ik ben even weg bij de stream omdat ik echt geen zin in heb gewoon. Ik ben even weg bij de stream omdat ik echt helemaal geen zin in heb gewoon.
Okay. Let me check. Data seems to suggest Binance and others were selling during the announcement. It would explain the dump. Let's see. I think Powell's speech is going to have the biggest event or the biggest effect in the end. We have been in this been expecting this for most of the time. We did know that would be the case because the rate cut was priced in, and we did know that QT could maybe be ending, and now he's going to give some comments on that in exactly 7 minutes. Paul is going to speak about that. So how is the Fed balance sheet going to look like? It is most definitely. We can say a lot about this FOMC and prices not moving and stuff, but it is most definitely going to be one of the most important meetings in a very long time. In a very long time. That is something I'm quite sure of, because the Fed balance sheet, guys, it does not get more important than that. It does not get more interesting than that. The Fed balance sheet. If it's going to be moving up, if QE is going to get started in the near future, it's going to be absolutely massive for the markets. So I think markets might be, I don't know, be a little bit boring now here, a little bit of a weird price action, but most definitely it's going to be very important. We have the speech coming up in about 5 minutes from now on. Let me check if everything is working still. 3 minutes, 3 minutes. 3 minutes. Yes, yes. And then the Fomc is going to get started. Okay, sorry guys, I had some technical issues, but look at that. We are now at the Fed live stream and it's going to start in the next minute. So I'm going to head over to the live stream now. I will be tuning my sound off and you guys can enjoy. And if I have something important to say, I will do so. But it's going to start in okay, sorry guys, I had some technical issues, but look at that. We are now at the Fed live stream and it's going to start in... There we go. There we go.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3 3/4 to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Nick Timrose of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that needs to be taken on board. We had, just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation, and then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation. We saw a very different picture of the labor market, and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, other people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
I'm Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. You can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And some will be more averse to inflation, overruns and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when more participants go out and talk, they're very disparate views. And they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, that we haven't made a decision about December. I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars because, again, with the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby. Thank you, Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, and we do have, we get some data. The labor market is a place where we get, for example, we get the state level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings, and we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market, and the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's the meeting's I guess 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
Steve.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way? Because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had two dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop at the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in treasury bills, which will foster both a more treasury balance sheet and also a shorter duration. So that's what, in the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities, and we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation, but we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments, but so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services, and we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be, 5 or 6 tenths, and so that, if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come, and it probably will increase further, but it is that it will be a one-time increase. And we've been very focused for all of this year at making sure that that's the case, and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say that first.
The stubborn services inflation that you mentioned.
Service inflation. Yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market, is because the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber, Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all. And could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles? How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard.
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about the lack, a continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys or the beige book, do you worry at some point you're going to have to start making policy by anecdote?
You know, this is a temporary state of affairs, and you know we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it, and that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that you know, what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, you know, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things you know, that we're watching very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully. And you know, yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or a similar thing. We are. If you listen to the earnings calls or the reports of, you know, big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there.
Edward.
Thank you, Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction in rates is not a foregone conclusion. So in December, you said far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then?
Well, the perspectives of people on the committee that, you know, we've now moved 150 basis points, and that we're down into you're into that range between 3 and 4, where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth, the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last 2 meetings, and there's a sense like, from some, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views.
Yeah, so on that division then, you're talking about going forward, so what's more important in this division? Is it inflation risks, is it employment risk, or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that, and as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues, and so we're at a place now where we have in fact cut 2 more times, and we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes, and I'm just telling you that's what happened in the meeting.
Elizabeth. Thank you so much. Elizabeth Scholzley with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor force participation, which is a cyclical thing, and then there's declining immigration, which is just a big policy change that actually began in the last administration and has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and so the unemployment rate has gone down, meaning that demand for workers is going down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand? And and I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to 0. So maximum employment doesn't, on a sustainable basis, if you're creating 0 jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last 2 meetings, that it was appropriate for us to react by supporting demand with our rates, and we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were, and that should help so that at least the labor market doesn't get worse. Though it's a complicated situation, and some people argue that this is